of professionals, business leaders, MSMEs, startups, and stakeholders from across the country. At the outset, we extend our sincere congratulations to the Honorable Finance Minister on the presentation of the Union Budget 2026-27. The budget reflects a strong commitment to inclusive growth, economic reforms, and structural reforms in the alignment with the Honorable Prime Minister's visionary roadmap of Viksit Bharat 2047. The Union Budget is more than a financial statement. It is a roadmap for the nation's economic directions. This year, budget assumes greater significance as it addresses emerging challenges while creating new opportunities for growth, innovation, and sustainability. Through this webinar, ISFA aim to provide practical insight into the key budget announcements and their impact on businesses, MSMEs, startups, and professionals. We are privileged to have with us two eminent speakers, CA Sachin Sinha, founder partner Prakash Sachin and Company, a experienced chartered accountant with extensive experience in taxation and advisory. The another speaker is Mr. Aradhya Deep Roy, Principal Associate Khetan and Co. LLP, an accomplished corporate lawyer specializing in tax policy and regulatory matters. The session will cover key highlights of the Union Budget 2026-27, major changes in direct taxes and indirect taxes, and its overall impact on MSMEs, startups, and corporates. We are confident that today's discussion will offer valuable clarity and actionable takeaways for you. Thank you all for joining us, and a special thank you to our distinguished speakers for sharing their time and expertise with our participants. Wish you an insightful and engaging session today. So now I hand over the stage to CA Sachin Sinha ji. Sachin ji, session is now in your hand. So we would like to hear from you the deep analysis of the budget on the direct taxes specifically. So over to you, sir.
Thank you so much, Akshat sir. Good afternoon to all. And I am very much thankful to ISFA for giving me this opportunity to discuss and decode the direct tax proposals tabled by our Honorable Finance Minister, Madam Nirmala Sitharaman ji, on this 1st of February. And if I take some time to discuss about the overview, I can say that this is the ninth budget in a row by Honorable Finance Minister. Before this, the Mr. Morarji Desai has tabled 10 union budget in a row. So ma'am is on the verge to break that record also, and she has already break the record of Mr. P. Chidambaram, who has also tabled 9 budget in his tenure. So this budget, if I refer, the major concern was the government was looking for is to how to make this is not for the purpose of giving the tax benefit, okay, increasing the slab rate, lowering the tax rate. So this time they have their thinking is very different, and they try to reduce the litigation. They try to give the convenience to the taxpayer so that the taxpayer can come forward and declare their tax. And as far as concerned to MSME, yes, I can say that MSME is the best, is the biggest getter in this budget. So I'm just allow me to share my presentation, and then I'll take through the proposals. So, sir, yes, is it visible to all, sir?
Yes, sir.
Okay. So I'm covering only the direct tax proposal, and the indirect tax proposal is to be taken care by Mr. Ajit Rai. So first of all, I can say that there is no change in the tax rate, so it will remain same as it was in the earlier in the preceding year. So whatever rate was prescribed for the individuals or the companies or the partnership firm, it will remain same and continue for this year as well. At the same time, it was the apprehension in the tax payers that whether this old regime will go this year or old regime will continue. So make it very clear, old regime will continue for this year also. One more important discussion was in the corner that whether this new income tax act will come into picture or will be enforced from 1st of April 2026, or it will be also be deferred. So Madam has clearly said in the parliament in her budget speech that from 1st of April 2026 the new income tax act will take place, and it will be effective from 1st of April 2026. So base rate discussion, tax rate discussion is now no more required because that is there is no change in it. So I'll discuss what are important and what are important for the MSME sector. The first important thing what they have tried to reduce the litigation, as I mentioned earlier, because if you see in the case of employer employee contribution and the payment by the to the provident fund or to the specified fund by the employer of the employee contribution, it was always a debatable issue that whether the timeline is prescribed under this section, what is the due date, whether due date is the due date as prescribed in that particular law, or the due date shall be as per as we used to say filing date of filing of return. So we have 43B for this, which says the date of filing of return is the date, but there are various judgments in this case, and if I refer to some judgment, you can see that Emil India, Savary Enterprises, Checkmate, there are various judgment and different court has given different judgment. Now the department has tried to settle this issue and said that the due date shall be the due date of filing of income tax return as per section 139(1). So they have not said 139(1) because this is effective from 1st April 2026. So the new section as per the which is in the new income tax act, so it will be 263 under bracket 1. So the due date shall be as per for the purpose of filing of income tax return as prescribed in section 263 subsection 1, it will be the due date. So one issue of debate and discussion now over, because the due date is now up to the date of filing of income tax return. The second issue is, which we always used to face, assuming an individual who is trying to purchase a house property of a non-resident, then what happened? He has to obtain the TAN number from the department. Because he is not in the business, so he is not required to having the TAN number, tax deduction account number. So he has to obtain the TAN number only for the purpose of this particular transaction. And once the transaction is over, he has to again surrender that TAN number, and at the time of making payment or credit, he has to deduct the tax, deposit to the government account, and file the return of TDS after the end of the particular quarter. So say in the month of January, the tax deduction is done, and then when he is liable to file the return in the month of April. So this was the 3-4 months gap, and in that period, the non-resident was also under the impression that because he is not able to see his credit in the credit ledger, so he is also very susceptible that whether the credit will come to him or not. So now the government has said, okay, no need to obtain TAN number. It will apply same as we are doing for the resident to resident based on the PAN number. So we used to deduct tax on the PAN number and file return challan come return. So similarly, we need to do in the case of non-resident also, but this is applicable only where it is an individual and HUF. If you are a company or if you are a partnership firm and you have a TAN number, then this benefit is not available to you. This is effective from 1st of April 2026. Another important benefit that we generally used to obtain the lower deduction certificate from the income tax department when we are making payment to a non-resident. So what we do, we furnish Form 13 along with all the documents. Then we need to visit to the concerned officer, explain him all the facts. Then he on his it is on his discretion he decides whether the tax how much the tax rate should be given to in this case. So now they have given the provision that this will be automatic, but it is only in the case of individual and HUF, and not for all cases. So similarly, assuming I'm buying a property from a non-resident, first I don't need to obtain the TAN number. Second, I don't need to approach to the department. It's an automatic process. We need to submit, and department will verify. If they ask, if they need some information, they will raise the query over the portal, and the deductor will reply to that query. Third important issue is generally the rate of TDS. So what happened? We always believe that the manpower services will fall under works contract. This was the understanding generally, but it was never nowhere prescribed in the law. So the work definition does not contain the supply. It was supply of labor, not supply of manpower. So what if, assuming a chartered accountant firm is giving some employee to the depute some employee to the client place, and that person will work as per the discretion of the client. They will follow their instructions. So it's a manpower service. Whether it will fall under the professional service and liable to deduct tax at the rate of 10%, or it will be tax will be deducted at the rate of 2%. So it was a debate in the professionals and in the taxpayers also. And generally, the taxpayer used to deduct 2% as per for the purpose of convenience, and the most of the money will go to the receiver. On the other hand, the some person will deduct 10% by saying that I don't want to go into the confusion or litigation. I will deduct 10% and deposit to the government account. If you have anything else, you can claim the refund. So this will block the fund flow to the receiver. So now the government has clarified that it will fall under the definition of work, and it will be and tax will be deducted at the rate of 2% only. So now no confusion, but again, this is applicable from 1st of April 2026. Fourth important amendment. This is very relevant for all the SSCs, whether you are an individual or a company. So generally what happened nowadays, the return filing dates are 31st of July for the purpose of an individual or HUF not carrying on business. Then if you are carrying on business and if you are not liable to get your accounts audited, then again 31st July. If you are liable to get your accounts audited, then 30th September is the due date for submitting the report, and 31st October is the filing of return. If your accounts is if you are liable to pay falling under the transfer pricing case, then the due date is 30th of November. And then the last date is 31st of December. Till then, you can revise the return or file the belated return. Assuming you missed the bus in the earlier dates, you can file the return within that 1 month period. Or if you fail to inform something to the government and now you want to revise the return, then again you have the only window of 1 month, or last up to 31st of December. Now the government has given the extra window, and by saying this, so this is the basic provision. Now they have added one more item into it and said, if you are an individual or an HUF and you or a company, and if your accounts are not required to be so if you're a company, of course your account is required to be audited somewhere. If you are an SSC whose accounts are not required to be audited in any other law, then in that case, your timeline or the due date would be 31st of August. So extra 1 month. Now till now it was up to 31st of July. Now they have given extra 1 month, so it will be filed up to 31st of August. So you can take some breathing, get some breathing space, because in case of uh, business, there are certain information which needs to be compiled. Stock details are needs to be compiled, and vendors payment outstanding details, input tax credit, output tax credit, so many things needs to be done. even though your accounts are not required to be audited, then in that case, they have given some extra 1 month period to get some breathing space. Similarly, as I mentioned, up to what was the timeline to file the revised return or the belated return is 31st of December. Beyond that, there's no scope of filing of revised return or belated return. Now they have said, okay, if you failed to, if you filed any information earlier, but you now realize that the whatever information you have furnished is incorrect and you want to revise your return, then you will get extra 3 months. It means the deadline is now not 31st of December, it will be 31st of March of the next year. So how much time? 3 months time you will get extra to revise the return. It sometime it happens that in the month of January you come to know that okay, we missed to we filed something in incorrect information earlier. Then you can revise the return up to 31st of March. But this benefit is only when you have filed the return earlier. If you have not filed the return earlier and you want to file the belated return, this is not available to you. But if the government is giving something to you, they will definitely ask something from you. So some fees is to be given for the filing of revised return. If you remember earlier there was no cost for filing the revised return, but now they are saying that you need to pay something for the revised return also. Since this proposal is effective from 1st of April 2026, so this benefit should also be given to the person whose income is subject to tax in the year 25-26. So if you are falling under the financial year 25-26, it means your assessment year is 26-27. Technically, this proposal should not be available to them, but with this amendment, they said this benefit would be available to that person also. It means if your income is falling under the period 25-26, you can revise the return up to 31st March 2027. Whether the person who has filed the return in the year 24-25 can also revise the return up to 31st of March 2026, the answer is no. This is not benefit, this is not available to them. This window is only for 25-26 previous year. Now come to next. As I mentioned, additional fees is required to be paid. How much is the fees? Either it is in the previous law or in the new law. So financial year 25-26 or 26-27 onwards. If the total income is less than 5 lakh, 1000 rupees is the additional fees which is to be given to revise the return. If it is more than 5 lakh, then 5000 is to be given as the to file the revised return. Same fees is for the 26 financial year 26-27 and the subsequent years. This is for revised return only. Again, the important challenge was with the updated return. If you remember, there was procedure for filing the updated return. Earlier, it was for 2 years only. Subsequently, they extended it to 4 years. Now you can file the updated return for 4 years. For 4 years by paying the additional tax. 25%, 50%, 60%, 75%. So this was the tax 70%. This was the tax rate, additional tax they asked. So 100% is the amount, then pay additional 60%. So under 160% you need to pay, 170% you need to pay to file the revised return, subject to the delay in the filing of return. So that is calculated on in that manner. The issue is this was the one-way traffic. If you have any loss, you cannot file the updated return. If you want to claim the refund, you cannot file the updated return. Even in case of nil income or zero income, you cannot file the updated return. So you need to pay something as tax to the government to file the updated return. Now they have amended this because this was actually one-way traffic. The SSC wants to declare the profit or wants to reduce the loss, but even in that case they cannot do so because the law does not allow to do so. So it says now if you want to reduce your loss, it will be allowed to you. So they have given this additional benefit. And this proposal is applicable for the preceding law also. So Income Tax Act 2025, yes, and Income Tax Act 1961, both it is available. Because for the Income Tax Act 1961, assuming your income is falling in the year 24-25 or 23-24, still you can file the updated return. So this corresponding amendment was actually very much required. So it is effective date is for the financial year 20 for the new Income Tax Act, it is 1st April 2026, because that law is coming from that date. For the Income Tax Act 1961, the effective date is 1st of March 2026. Why 1st of March? Because you can file up to because law says if it is available on that date, on 31st of March, it will be flow accordingly. So that's why they have made this amendment. So if you want to file an updated return and you want to reduce your loss, wait for 2 months and file your return, or wait for 1 month and then file after 1st of April to 1st of March 2026. Another issue relating to updated return was, if, as I mentioned, that if your case is if your return is a loss return, you cannot file updated return earlier. If your return is a nil income return, you cannot file updated return. If you want to claim the refund, you cannot file the updated return. Similarly, if your case has been selected for any proceeding, then you cannot file the updated return. Now, law has said that even though your case has been selected by the income tax department for the purpose of scrutiny or for the purpose of reassessment, you can still file. The updated return and correct the return, because now you know what are the information available with the department. So you want to reduce the litigation. I don't want to go into the litigation. Okay, I accept my fault. I accept my default, and I want to correct my return now. So you can do so by paying the additional tax, and the additional tax is to be calculated based on the periods elapsed, and accordingly it will to be the additional tax is to be paid. So if it is so, the government has tried to reduce the litigation and giving you the opportunity. First, file your return on time. If you fail to file your if you file the return and you realize that there is some mistakes are there, you can revise your return. Subsequently, if you have filed the return earlier or not filed the return, you can file the updated return in 1 year, 2 year, 3 year, 4 year. Assuming your case has been selected by for the purpose of reassessment, and you know that the department has all the information, what are the information with them. Based on that, you want to update your return, you can file the updated return till that time also. So government don't want to go into the litigation. They say, I am giving you the ample opportunity to correct yourself. But every time you are correcting yourself, you need to pay something extra. And that's why this something extra is also here. As I mentioned, that the additional tax is 25%, 50%, 60%, and 70% that needs to be paid depending upon the period elapsed. But this is not all over. Here you need to pay some additional tax also. And this additional tax is increased by 10%. So assuming your case is already is being done, selected for reassessment purpose, now you want to file your return, updated return. So whatever tax you are supposed to pay, say assuming you are liable to pay 100% plus 60% as the 3 years has already elapsed, then you need to pay 10% more, just as a settlement fees, you can say. And then you need nothing to worry, the department will drop the case. Here it is important to understand that what if I have already declared my income, I have already paid the additional tax, whether the department will invoke the penalty based on the information I have furnished in the return. So department will based on this information what you have furnished in the return, not pick up the case for the purpose of penalty. So this they have given you the question that okay, I can save the penalty to some extent. Again, this is applicable from 1st of April 2026. Of course, this benefit is given to the preceding law also. So, if in the 1961 Act, they have given the similar benefit, and this is effective from 1st of April 2026. This is important and beneficial to the SSE. Again, important amendment which department has come with. In the month of November or December, you might have received the notice from the department that a certain amount of foreign income or foreign asset is lying outside India, and if it belongs to you, please update your return or revise your return within the time prescribed. So this was the great hue and cry amongst the taxpayers that department has all the information and now you need to furnish. In most of the cases, what we observed that the SSC was not even aware about that particular asset. What are those assets? So assuming you have a bank account outside India. So assuming I was in US for the purpose of my employment 5 years back, and there I opened a bank account and only 100 USD is lying, or 1000 USD is lying. I came back to India. Now I become resident of India, and I'm that bank account, I'm not operating that bank account now, but still that information is with the government of India that you have a bank account, but you by chance forget to report in the income tax return. So now the government has given you the opportunity to disclose that in asset, those type of assets, or you have any certain income which belongs to outside India or in a foreign country, but you unfortunately or fortunately, knowingly or unknowingly, you forget to declare in the income tax return. Now the government says if you missed that opportunity, you declare that income in the income tax return. So this is a welcome step, because as you know, if you fail to disclose such type of income or such type of asset in the return, then the Black Money Act will come into picture, and the penalty was to be invoked as per the black money law and not as per the Income Tax Act. So for the purpose, or to the extent of this, the government has given you the benefit. In most of the case, what we have observed that the employee is resident of India working in an Indian company, and Indian company is the subsidiary of a foreign company, and the foreign company has given the ESOP to that employee, and that ESOP is in the foreign country. Even the employee is aware about that ESOP, but failed to disclose that ESOP in the income tax return, because that is an income per se, number one, and that is an asset, foreign asset also. So these two are to be reported in the income tax return, but unfortunately the SSC fails to declare whether he is liable to pay penalty. Now this time the government has given the relaxation by saying that, okay, if you fail to do so, I'm giving you an opportunity through this fast DS 2026. If what there are two categories. One is undisclosed assets located outside India, or undisclosed foreign income outside India. If you have undisclosed asset, whatever is the value of that assets, 30% would be considered as tax. If you have foreign income outside India, 30% of that income is subject to tax. And then another 100% is to be top up of that 60%. So in totality, asset plus income, you need to pay 30% plus 30%, and then 30% extra on that income. So 100% of the determined amount. So this is additional tax or additional tax you need to pay. But this benefit is available only to the extent if your asset or income is not exceeding 1 crore rupees. If your income or asset is exceeding 1 crore rupees, then this benefit is not available to you. Even though you want to pay, I'll pay 30%. No way. Your case will fall under the black money law. So this is one situation. The second situation is assuming I was resident of India. I was earlier resident of US, earned income there, paid tax there, and acquired one asset. Now I came back to India, but that asset is remaining there, but I forgot to report that asset. Do I need to disclose it here? Yes, now you are required to disclose here. How much I need to pay for this? Only 1 lakh rupees. 1 lakh rupees. No 30%, only 1 lakh rupees. The second part is you was acquired the asset outside India when you was resident of India, but and you acquired the property outside India, but failed to disclose 1 lakh rupees. So this is only applicable when your asset value is not exceeding 5 crore rupees. If your asset value is exceeding 5 crore rupees, then again the black money law will applicable, and this FASTDS is not available to you. So they have also defined what is the meaning of undisclosed assets, what is the meaning of undisclosed foreign income, and the value of asset, how it is to be determined. The fair market value of that asset determined in such manner as may be prescribed. So this is the value, this is the method which is given. Now come to the second part. Relaxation of condition of prosecution under the Black Money Act. So they have given, so since you're declaring the income, so they say you'll not be prosecuted in this law. But this is available, this is applicable from 1st of October 2024, because this law was come in the year 2024. So they say now you can update from the year 2024. Prosecution, in the case of prosecution proceeding, the government has given a very good relaxation. In most of the cases, assuming you fail to disclose your income, which is exceeding the prescribed limit, then you are subject to prosecution. If you fail to deposit the tax, subject to prosecution. And there are certain items in which case you will be subject to prosecution. And in that case, the imprisonment was the rigorous imprisonment, and that period was different period was there, and that imprisonment, rigorous imprisonment, and then you need to pay fine also. Need to pay fine also. So here they have tried, what they have done, in wherever it was rigorous imprisonment, they made it simple imprisonment. So now, earlier it was like chakki pissing. Now this is very simple. No chakki pissing is required, but yes, the period they have changed accordingly. So in some cases where it was may extended to 2 years, in if you can see in the first case, it was may extended to 2 year. In the second, in the proposed provision, yes, it is similar, same line. In the case of the second provision, rigorous imprisonment for the term which may extend to 2 year. This is now they have made it simple imprisonment, extend up to 6 months. So reduce the time limit also, but you are liable to pay fine. In this provision, they say the removal of contravention of transport delivery, rigorous imprisonment for 2 years, and with the fine, now this is simple imprisonment up to 2 years. Failure to pay tax under Chapter 17B. You deducted the tax but failed to deposit to the government account. Earlier, the imprisonment was, it was rigorous imprisonment, and the period starting from 3 months to 7 years. So this was the wide scope which was given, 3 months to 7 years, and with fine. So now they have made it simple imprisonment for 2 years. If it is more than 50 lakhs. If the default is less than 50 lakh, more than 10 lakh, then 6 months imprisonment. And if it is less than 10 lakh, then no imprisonment. So now they have tried to reduce or eliminate the proposal for that situation where the imprisonment was there, by saying that if it is less than 10 lakh, no imprisonment is there. You need to only pay the fine. So these are all welcome step. This may reduce the cost of the department also for the purpose of litigation, and at the same time it will reduce the cost of the SSC also, because 3 months to 7 years, it was long time, and the sometime the SSC was being blackmailed by the authorities or by the court, that okay, you need to pay, otherwise we will push you behind the bar for 7 years. Now it is 2 years, but imprisonment, whether it is simple or rigorous, I always request everyone, if you have deducted the tax, deposit it within the prescribed time. Otherwise, prosecution is always there. If you do willful attempt to evade the tax, then of course the penalty, the imprisonment is there. So I'll not deep dive into this much. Okay, now they have reduced certain penalties also, or changed the provisions of penalty. So generally what happen when you are supposed to get your accounts audited by a chartered accountant, say tax audit, we generally use this term tax audit, and fail to do so So what the timeline to furnish the report is 30th of September, but you fail to do so, then in that case, the penalty is 0.5% of the turnover or 1.5 lakh, whichever is lower. So say your total turnover is say 10 crore rupees, then 0.5 is that. So 10 crore is 10 lakh. So 5 lakh was the penalty. So you need to pay 1.5 lakh as penalty and uh, not 0.5%. But this was penalty. So penalty, generally what happen, you file a return and then department issue a notice of penalty. Then you fight the notice of penalty. Then if department if you agrees or both agrees, then you need to pay. Otherwise, you can challenge that notice. Now they have said no need to go for this litigation. I'll issue a notice. Then you will pay the you will fight that notice. It is better pay the fees. So at the time of filing of return, if you are delay by 1 day or 10 day or 100 day, you need to pay 75%, 75,000 if the delay is for 1 month. If the delay is for more than 1 month, 1.5 lakh, irrespective of turnover. So assuming my turnover is say 10 crore rupees, then I less than 1 month, I'll need to pay 75,000, and if it is more than 1 month, I need to pay 1.5 lakh rupees. But the issue is there are certain SSCs who are technically not required to get their accounts because of the turnover threshold, but they are required to audit because they come out from the option that is scheme. So in that case, that 44AB clause E applies. Then in that case, that even you have the lesser amount of turnover or lower amount of turnover, then what will be the position? Similarly, if you are a professional, then your turnover is even 1 crore rupees, you are required to get your accounts audited. Assuming you missed the bus, then you need to pay 0.5%, say 50,000 as penalty. Now you have to pay 75,000 or 1.5 lakh as penalty if depending upon the period of delay. So this is I can say convenient, or you can say difficult also. The another penalty is that the transfer pricing report, earlier it was 1 lakh rupees if you failed to furnish that report. Now it is 50,000 for 1 month, 1 lakh for thereafter. Similarly, if you are liable to pay file SFT, significant financial transaction, specified financial transaction, then in that case, earlier the penalty was 500 rupees per day. Now they've increased it to 1 lakh rupees, maximum 1 lakh rupees. This is important. This is very important amendment. Earlier there was a provision which we say section 68 family, section 68, 69A, 69B, C, D, E, B, C, D, where the department was always try to push the SSC in that section. Why? The tax rate was 30%. Tax rate was 30%, and then the surcharge and education says makes it say 70%, for example, and then penalty of 10% on that top. So say it becomes 77 or 78% somewhere. This was the amount which you need to pay if your case falling under section 68, 69A, 69A, B, C, D. Now they have reduced this 60% to 30%. And this is effective from 1st of April 2026. So if you have certain income which you which you don't know the source, nature or source, then you can declare it in that particular section, and the tax rate would be not 60%, it will be 30%. But what important change is there? They have applied the penalty on it. Earlier penalty was 10%. Now they have made it penalty of 200% on it. So by saying that it is a penalty of due to misreporting, whether penalty will be invocable or not, that is subject to debate. But now the provision, what we are discussing, the provision, as per the provision, you are liable to pay 200% penalty on that income. So say 30% is my income, and exceeding aggregating surcharge and education says it become 36 or 37%. Now 200% penalty. So it is more than 100%. So what benefit SSC will get from out of it? Nobody knows. And this is applicable from 1st of April 2026. Misreporting, we discussed this part. This is related to the same section 68, 69. MAT provision is very important. So you know that there are provision which is related to minimum alternative tax. It means if your book profit, book profit is higher than the tax profit, then you need to pay tax at the rate of 15%. And when your tax profit is higher than the book profit, then pay the normal tax, and then you can claim the tax credit out of it. Then you can claim the tax credit out of it. Okay. So in that case, what happened? Most of the SSC claim the tax credit subsequently. So first of all, they have reduced this 15% MAT to 14%. 1% benefit is given. This is one part, and this is applicable from 1st April 2026. The second important part is most of the SSCs who was in the old regime. Old regime means you were supposed to pay 30% tax or 25% tax. From by way of section 115 BBA, now you can pay 22% tax. 22% tax if you're a domestic company. If you opt for that, then this MAT benefit or MAT provision is not applicable to you, and you are liable to pay 22%, irrespective of the whether your book profit is higher or lesser. Forget, calculate the tax on the tax profit, because there is now no need to calculate the book profit. Calculate the tax profit and pay tax at the rate of 15%. Now it is 14%. Most of the SSCs, what they did, once this law was came that is 22%, they opted for 22%. Unfortunately, the provision which is given in this 22% law is, if you once opted, you cannot go back. You cannot go back. It means then you, whatever tax or MAT credit was available to you, now you cannot claim that MAT credit. Number one. Number two, this is also the apprehension of most of the SSCs. They want to shift themselves from old regime to new regime, but they are not able to do so because they have huge MAT credit available to them and they don't want to do so. Now, the government has said that, okay, if you have MAT credit earlier, you can claim it to the extent of 25% of the tax liability in year one, to the extent of 25% of the liability in year two, and so on, up to 15 years. So those SSC who are still in the old regime, now they can opt for the new regime, and still they have certain MAT credit available in their books. They can claim that MAT credit, not in year one, all the credit in subsequent years they can claim. So this is welcome step from the government to make the SSC this make the situation simplified, so that the SSC can opt for the new regime. TCS rate, always a challenge, and I'll not discuss that Tendu leaves scrap. This is all made, they have made 2%. The important change which is related to LRS scheme, because we generally used to send some money outside India, either for the purpose of education of our children or for the purpose of medical treatment. So earlier it was 5%, now they have made it 2%. Similarly, 20% was for the purpose other than education and medical treatment. It means you are sending some money, you are gifting to someone else, then it will be 20%. It will remain 20% in the new law also. One part. Second part is, when you book a overseas tour program package through a authorized person, then the tax liability earlier was, if the total amount is less than 10 lakh, then 5% would be the TCS, and if it is more than 10 lakh, then the 20% would be the TCS. Now they have made it 2%. So it is better if you're planning to go
Hello.
outside. Yes, sir.
Ji.
Now it is better if you are planning to go outside for the purpose of travel, then book your travel through the overseas tour package or tour program package, so that the TCS would be 2%, and do not spend from your side, and then carry the money for the purpose of the remaining amount for the purpose of your travel, just to reduce the TCS burden. Jao versus FAO is again excellent decision. So many judgment was there, whether it is who is the authority to issue the notice under section 148 capital A, whether it is the jurisdictional assessing officer or the faceless assessing officer. And this matter went up to Supreme Court also, and various court has given the various judgment. So now they have clarified that the authority is the jurisdictional assessing officer and not the faceless assessing officer. But they have not clarified that what if in the case where the SSC has the notice was issued by the faceless assessing officer, what would be the fate for that cases in those cases. So technically speaking, now the jurisdictional assessing officer is the authority to issue the notice under section 148 capital A. Then further notice will be followed through by the faceless assessing officer. This is again for the to reduce the litigation. In most of the cases, if the DIN number is not mentioned in the notice or the order, we used to say that this is not a valid document. Now they have made it clarified that even though the notice is it is not containing, but the DIN number is officer, then it is a valid. This is important. Dividend is, as you all know, that dividend is subject to tax under the head income from other sources. There was only one provision which talks about the deduction of expenditure towards interest, which is incurred by the person who is earning the income. So assuming I have taken some loan and invested somewhere, so whatever dividend I have received is taxable, but I can claim the 20% of the interest amount from that. So 20% of gross dividend amount I can claim as dividend as an interest expenditure if I have incurred that amount. So this was the expenditure. So assuming I have taken loan and paying the interest, and my income, dividend income is 100 and paid 20 rupees as interest. So I can claim 20 rupees as deduction. Now I need to pay tax on 80 rupees only. Now the government said that deduction is not available to you. Forget whatever income you are getting, you are liable to pay tax on that item. So this is applicable again from 1st of April 2026. Difficult for the SSC because those who had taken the loan for the purpose of this, now they are not able to claim that expenditure. No deduction shall be allowed. Buyback of share is again a critical issue. If you remember, prior to 2022, because this was come in 24, so prior to 2023, 24, what happened if the company is buying back the share, buying back its own share, then the company is liable to pay a capital gain on that income. So it was subject to capital gain, and whatever cost of acquisition is there, or the promoter has purchased buying back this, then the company, then whatever cost of acquisition was there, they can claim as an expenditure earlier as a cost of acquisition. For 24-25, they have made the changes, and then they said it will be considered as dividend. Inserted section 222F by and said it will be considered as dividend. So, and it will be taxed at the rate of 30%. No deduction is available. Only the cost of acquisition shall be considered as negative. So negative cost of acquisition would be there. If you have any capital gain, you can set off that capital loss up to 8 years. So this was the provision for 24-25, 25-26. Now they have understand the issues and made this amendment by saying that, okay, generally what happened, who is taking this decision? The majority stakeholder. So, but this law applies to the minority stakeholder also. So now they are saying that if you are a minority stakeholder, then you will get some relief. So they said the company, if the person who is getting the benefit, who is buying back the share is the promoter, then the tax rate would be 30%, which is similar to earlier law. But this 30% will be subject to deduction of cost of acquisition. Number one. Number two, if the promoter is the company, then the effective tax rate would be 22%. How this 22% is to be calculated? So they have given this table by saying if it is a short term, then on short term capital gain, tax rate is 20%. So they say made top up of 2%, so it will become 22%. So it will become 22%. Further, if it is a long term capital asset, so the tax rate is 12.5%. So top up by 9.5%. So it will become 22%. This is only when you are a resident domestic company. But if you are not a domestic company, then the tax rate would be 30%. Again, the top-up mechanism is given. Interesting to know that the promoter is defined in this provision, and they said provision as defined in promoters as defined in section 2 under bracket 16 of the Companies Act. This is one part. And the second part is, sorry. Sir, is it visible, sir? Akshat,
Yes,
sir, is
sir.
visible, na? Okay. The second part is, if you are not a domestic company, sorry, if you are falling under 269, you are a promoter. Or if you are holding 10% or more in the company, then you are a promoter. Whether you are satisfying the condition of 269 or not, that is immaterial. Last but not the least, they have increased the STT also. So that is called the security transaction tax, and that's why the share market was fluctuated heavily on the budget day. So they made it, if it is a sale of an option in securities, then it is 0.1%. Now they change it to 0.15%. If it is sale of an option where the option is exercised, 0.125%, it was the earlier rate. Now they made it 0.15%. And if it is sale of future in securities, then earlier it was 0.2%, now made it 0.25%. Again, effective from 1st of April 2026. So thank you so much. I have shared the brief about the tax proposals, direct tax proposals, which is tabled by our Honorable Finance Minister in this budget. I am here to take up some queries if you have.
Yeah, we have two questions related to your presentation, sir. One is what happens if the non-resident does not have a PAN number? Then how will the buyer deduct the remit TDS, and how will non-resident get the CR of TDS?
Okay. So if you are owning any property in India, it is always required as a mandatory to have a PAN number in India, because if you refer to the PAN number proposal, who are the person liable to having a PAN number, then in that case you will file. If you are having an immovable property in India, you have to have a PAN number, because if you're selling that property, you need to file the return irrespective of the amount, because you are earning capital gain, you need to file the return. So for that purpose, you have to obtain the PAN number. Otherwise, it is not possible for the department to track the transaction, because when you go to the registrar office, the registrar will first ask for the PAN number, and that on that basis it will be reported to the government. So it is mandatory to have a PAN number, sir. What is the
Next
second?
question is TDS supply of manpower, whether 2% applies for all categories of recipients, individual, HUF, firm or companies.
Yes. So now they have made it because what they have done, they have changed, they have added manpower services in the definition of works contract. And the works contract, in the case of works contract, the person who is liable to uh, who are the payer, is liable to deduct the tax. Now the tax rate is 2%. But the earlier provision, which is if you are making payment to an individual HUF, the tax rate would be 1%. If other than individual HUF, deduct 2%. That will remain there. There is no change in that proposal, that provision. The only addition is the definition in the works contract. They have added manpower services. Remaining provision, that at what rate it is to be deducted, 1% in case of individual HUF and 2% in the case of other than individual HUF, that will remain there.
Okay. So these two questions we have only with us.
Okay.
So now I would like to invite our next speaker, Mr. Roy. He will cover the indirect tax part of the budget. Now over to you, Mr. Roy.
So before this, I want to sincerely thanks to all the participants who are here and to the ISFA for giving me this opportunity. If you have any query, you have my email ID. Please feel free to share all the queries. I will try to reply. Thank you so much for the opportunity, sir. Thank you so much.
Thank you. Thank you very much, sir.
Thank you, sir.
Thank you, Akshatji, for the kind introduction. Good evening, everyone. Sachin sir very elaborately covered the direct tax aspects. I'm here to cover the indirect tax aspects. Before probably jumping on to the nitty-gritties of the changes brought about on the indirect tax side, on the customs side, a brief overview as to what the budget probably tried to achieve in the indirect tax domain is will be helpful. So as you all are aware, at a global level, we are navigating tough waters. At a global level, with punitive tariff threats being imposed, with reciprocative tariffs being imposed, the entire global market right now, for especially for Indian exporters, MSMEs, and small businesses, is something which is creating a lot of confusion, a lot of ambiguity on that front. So the purpose of the budget primarily was to focus on domestic manufacturing, was to focus on giving impetus to the backbone of the Indian economy, which are the MSMEs, and that we can see in as much as 10,000 crore outlay has been specifically earmarked for the MSME industries in various forms and manner, like easier credit guarantees and all. So the idea of the budget was not to hand out freebies. It was rather to create an economy, create a domestic supply chain economy with necessary incentives and necessary alignment of tariffs on the customs side so as to boost domestic production and also incentivize exports. So it is in this context that our Honorable Finance Minister presented the budget, and obviously a lot of it will have to be tested in the coming days as to how the eventual implications fall out. However, coming to the nitty-gritties of the budget, I'll just share my presentation. Is it visible? Is my screen visible?
Yes.
Okay. So the idea, as we have laid down the context, is that it has to be seen in the context of various global treaties that we have executed now. Like, for example, recently, I mean, there are news that India-US trade agreement has been executed. We have already completed the India-EU FTA. Last year, we completed it with UK. Before that, with Australia. So a lot of global trade agreements have been concluded, which will give access to various Indian products. So the changes made in the budget will have to be seen in the context of India's international relations at this time. As I have touched upon, massive fund outlays have been made for electronic manufacturing and MSME sector specifically. On the customs side, there has been a lot of pruning of exemptions. So basically, in the customs side, what the budget has intended to do is it has, as per the practice, it was that exemption notifications used to be issued. So there was an effective rate of, customs duty under the Customs Tariff Act, followed by notifications wherein the standard rate of duty was prescribed under the Customs Tariff Act, followed by the effective rate in the notifications that were issued. So that has been sought to be streamlined. uh, for warehouse manufacturing and storage, one aspect which we have practically seen, and MSMEs also face this issue, is for movement of goods from one warehouse to another warehouse within the customs bonded premises required the approval of the proper officer, so to say, or the customs officer. But as a sense of ease of doing business, these sort of requirements have been relaxed. And the idea is to, from service-led economic growth, the idea is to now push the economy towards more manufacturing-led economic growth. Now, coming to the goods and service tax related changes. So, obviously, as we are all aware, goods and service tax related changes are mostly done pursuant to the recommendations of the Goods and Service Tax Council. We had what we have, colloquially called GST 2.0 in September of 2025, wherein there was a huge amount of rate rationalization, both on the service side and on the goods side. And there were a lot of recommendations which were made as a measure of trade facilitation. A lot of recommendations were made to clear out long-standing disputes and debates in the industry, some of which have now been formally notified through the budget of 2026. So the first thing is with respect to post-supply discount. So the law prior to this was that for any post-supply discount, that is a discount which is given after a supply has been completed, it had to meet a couple of conditions. One of the conditions was that the discount which has been offered had to be linked to a particular agreement and to a particular invoice which was issued. So there had to be a one-to-one linkage between the discount, the agreement, and the invoice. Now, at a practical level, most of the industries, be it at an MNC level, wholesale level, MSME level, a lot of discounts which are especially quantity based, which are especially volume based, which are especially target based, has to have that fluidity around it. It is difficult to agree to each and every terms and conditions at the time of entering into the agreement. Therefore, to link the post-sale discount with agreement and then to relevant invoices was something which was a difficulty which was faced by the trade, and a lot of litigation on in terms of discounts not being allowed to be deducted from the value of supply. We saw these sort of disputes. So now this has been done away with. The only requirement statutorily for post-sale discount to claim a post-sale discount or to claim the post-sale discount as an exclusion from the value of supply is that a credit note has to be issued, and that the credit note and once the credit note is issued, the recipient has to reverse the commensurate ITC which was availed by it, which was there earlier as well. So now it is not documentarily required that it has to be linked to agreement and invoices, which is a welcome step for the entire industry, for MSMEs, for small sectors. It obviates and it does away with the need to have agreement linkage and one-to-one invoice linkage, as long as the normal requirement or the condition that credit note issuance and subsequent reversal of ITC is met, that should be sufficient to claim a post-supply discount. However, having said that, this probably, while on the face of it, it seems to be a welcome amendment, does it completely do away with the disputes that we see with respect to discount? Probably not, because the GST department on many occasions have taken a view, have taken a position that these sort of discounts are not discounts per se, rather they are in the form of additional consideration. So while this amendment takes care of one part of the dispute, this may not end the total litigation that we see with respect to claiming of discounts from the value of supply. The larger issue of whether a discount qualifies as a consideration or is a discount simpliciter still remains, and it has to be adjusted on a case-to-case basis. But what it also does is, from a transactional perspective, we cannot lose sight of the fact that now that this amendment will be there once the Finance Act receives its assent, is when we enter into contracts with parties, and this applies to large MNCs, MSMEs, small scale businesses, startups. Whenever we enter into contracts, one of the portion of the contracts will have to now very categorically lay down, or rather delineate, the responsibilities of the supplier and the recipient. It should identify that once a credit note is issued by the supplier, the recipient has to reverse the ITC. So these sort of contractual responsibilities now is more required to be delineated in the contract itself, so that from a transactional perspective, tomorrow if there is any dispute as to whether credit was reversed or not reversed, from a contractual perspective, the respective parties can take their position. So this is something which one must keep in mind, and probably reevaluate the contractual clauses with respect to offering of discounts in light of this amendment. In terms of the amendment to section 15(3)(b), there has been a corresponding amendment in section 34, which pertains to issuance of credit note. So once a credit note stands issued in terms of section 34, it relates back to the fact that ITC has to be reversed for a post-supply discount. So 15(3)(b) omission for that matter, or amendment for that matter, is in line with what has been incorporated in section 34 of the CGST Act. One thing which has been proposed is section 54(6) has been amended with respect to provisional refund for inverted duty goods. So this is again a welcome step. Inverted duty, as we all are aware, leads to blockage of while we can claim refund, it was not the provisional refund of 90% refund being granted within 7 days of filing the refund application was not available for inverted duty structure. And especially in textiles, footwear, these are the sectors, and MSME sectors, these are the sectors wherein we see a lot of inverted duty related issues. So it led to a blockage of working capital. But now with provisional refund in place, even for the inverted duty scenario, it is expected that the cash flow will increase, especially for sectors wherein there is a huge cash cash blockage. And however, that does not eventually mean or imply that provisional refund will eventually mean refund. The normal scrutiny will take place after the refund is eventually once the refund, whether the refund is to be eventually sanctioned or it has to be claimed back, is something which it will still be subject to the necessary verification. However, the time limit for getting the provisional refund in case of inverted duty structure has now been brought at par with other forms of refund. One aspect which has been also considered is the constitution of NAA for advance ruling. While it was always there under section 101A, however, unfortunately, it has not seen light of the day. What this finance bill proposes to do is basically designate any existing authority, which can be a tribunal also, to hear those cases wherein there are conflicting advance rulings or conflicting rulings of the appellate authority of advance rulings. So we have seen, as a matter of fact, for various e-commerce companies, that on the same facts, on the same circumstances, ARs have taken different rulings, and this primarily flows from the fact that since the AR, since CGST Act provides that the AR is binding only on the assessee and the jurisdictional officer, on this ground, we have seen contrary rulings coming out on the same facts, on same, probably even on same products, wherein one state is classifying it under one CT or one customs tariff heading, and the other state is classifying it under another HSM. So to take and cure these disputes, the concept of NA was framed so that we have uniformity. Unfortunately, that did not see light of the day as of yet. So to address these issues, the government has, through this finance bill, stated that an existing authority or a tribunal will be notified, which will hear the AR cases. This is in line with the fact that we want to have ease of doing business in classification sort of disputes, wherein you have conflicting rulings. It is expected that now there will, as and when the authority starts functioning, some sort of clarity can be expected for issues on which there are contrary rulings. Now, moving on to the IGST Act, this is one of the most important recommendations that was there of GST Council back in September 2022 or September 2025, wherein intermediary, the exception to determining the place of supply in case of export of services, it was recommended to be omitted. As we are aware, on export of services, there is basically zero rating, and quite rightly so, because exports are not taxed. That's the intent behind export. But the exception was that if you are an intermediary, or place of supply was deemed to be in India. Now, department had always been, for any sort of scenario where export was involved, place of supply was eventually as per the department in India. So this impacted BPO sectors, this impacted normal export-oriented sectors, MSMEs. It impacted e-commerce sectors for those companies which are providing support services probably to their parent company. So this is an issue which has kind of impacted the length and breadth of the economy, and we have seen innumerable litigations. In fact, litigation on whether an entity is an intermediary or an exporter of service has been there since the service tax regime, since the place of provision of service rules. And despite authoritative pronouncements on how to interpret the intermediary provision, despite the fact that department itself has issued circular number 159 back in 2021, culling out the parameters of intermediary, yet there was no end to this dispute, because invariably the taxpayer and the department differed when it came to application of this provision. But recognizing the need to boost exports and ensure that the sector is overall not impacted, what it has done is, it has, after the GST Council recommendation 25, this has now formally been formally been provided for in the finance bill, that section 13(8)(b) would be omitted. Now, an interesting aspect which arises, especially in context of litigation, is that the clause has been recommended to be omitted, and there is no repeal and saving clause as of now. So, can a judicial position be taken? Can an argument be taken that since the provision, which is section 13(8)(b), has been recommended to be omitted without any concomitant repeal and saving clause, does it mean that section 13(8)(b) never existed in the statute book? Does it mean that for all the pending litigations, be it before high courts or Supreme Court, can we take the position that since section 13(8)(b) has not been saved, it means that it was not there from in the statute book since July 1, 2017? Or because it's a statute and not delegated legislation, the omission is not from a rule but from a parent statute, does the provision gets saved under the General Clauses Act? So this is a very fine, nuanced legal debate which we foresee will now arise on the pending matters. Obviously, going forward, once this is formally notified and it's omitted, intermediary related issues, especially on the export side, should not be there. But on the pending disputes, this is a legal debate which we foresee can arise. Now, moving on to customs laws. So bulk of the amendments which have been proposed obviously is in the customs side. So one aspect is the deferred payment of import duty rules. Now, obviously, what we have today is a system of authorized economic operators, T2, T3 as we call them. They have the flexibility to defer the payment of customs duty for 15 days. That timeline is now proposed to be extended to 30 days. And what is sought to be introduced is the eligible manufacturers option. Basically, whosoever will qualify as an eligible manufacturer importer, and who qualifies as an eligible manufacturer importer will need to be approved by the Directorate of International Customs. But the idea is, if there is an importer who qualifies as an eligible manufacturer importer, it need not pay the customs duty upfront. It can pay the duty under deferred payment of import duty rules and defer it by 30 days. So what it does is it unlocks the working capital which is blocked at the stage of import. This is something which is done so as to ensure that imports made are cleared without any bottlenecks at the import stage. Company importing is not worried about whether and in what stage the out of charge order will be given. All of it is seemed to be done in a time bound manner, so without the aspect of having to pay the customs duty upfront, which can be a huge bottleneck for it, especially for MSMEs and for small scale sectors, small scale operators. So this is something which can be which can be evaluated in the coming days, and is done with the intent of again boosting the import and the export both. The second core change has been the baggage rules. So obviously, baggage rules are something which regulated the duty-free allowance for when we fly down when we fly into the country, for the allowable limit that has been revised for both for individuals and for tourists of Indian origin, or for tourists or for a valid visa holder. So primarily, what was earlier the allowance was for 50,000 has been increased to 75,000. For tourists of foreign origin, it is pegged at 25,000, and for crew members, it is for 2,500. So basically, goods not exceeding this much amount, and goods which are not mentioned in annexure 1 of the baggage rules, which are basically guns and cartridges and all, those are the excluded categories, so you cannot bring them. But as otherwise, goods which are there, you can get it into the country subject to these allowance limits. Obviously, the mode of travel has to be arriving other than through land. What has also been done in this particular finance bill is there has been an allowance for jewelry. So used personal jewelry, which can be required for personal use, is also now allowed as a duty-free clearance. So that is something which was not there in the earlier baggage rules, but now it has been recommended in this baggage rules. Now, there are a few more changes which have been proposed to the customs law. First is section 28(6), which provides that penalty paid under that section shall be deemed to be a charge for non-payment of duty. Now, what is the context? The context is whenever a customs show cause notice is issued under section 28(5), which is basically the aspect where they invoke fraud or willful suppression or misrepresentation to allege evasion of customs duty. The SSC has an option to pay the duty demanded, the interest, and 15% of the penalty within 30 days after the issuance of show cause notice. Now, what this clause 6.2 does, 6.2 do is the 15% penalty done, the 15% penalty, if it is paid, it will not be equated or characterized as a payment of penalty. Rather, it will be characterized as a payment of duty. Now, what changes? It's not that financially it has an impact, because 15% will still be going out of the pocket. What changes is the optics. When you pay 15% duty, if for example for AEOs and eventually for these manufacturers, eligible manufacturer importer, let's be cognizant of the fact that having a penalty record in your book in your company is a red flag. If it's seen that you have been slapped with penalties, then it's something which does not augur well for the businesses, and especially for businesses at a smaller scale. So what the government has done is, instead of characterizing it as penalty, they have characterized it as payment of duty, which will eventually also not lead to downgradation of the status of any importers, of any AEOs or eligible manufacturers. So that's the purpose and intent behind this clause. Section 28(j)(2) has been proposed to be amended, which is basically the duration of the validity of an advance ruling is now proposed to be amended or extended till 5 years from the current 3 years. So this again is aimed towards ensuring that continuity in law, continuity or uniformity in the application of law is there, and therefore the time limit has been extended. There is the proposed insertion of section 56A. So 56A basically pertains to the fisheries. In fact, our Honorable Finance Minister, in her opening statements in the budget speech, had indicated, had in detailed manner stated that fisheries within the not 12 nautical miles of India is something that they are targeting as a sector. So 56A in essence basically says that if there is a fish which is harvested in an Indian flagged vessel, even beyond 12 nautical miles, that is within the exclusive economic zone. And if that is brought into India, no duty will be levied. And that if it falls directly, is exported from there, then if it lands in a foreign port, it will be considered as export. In essence, such harvested fish, if brought into India, will not be subject to BCD. And if it's sent outside from that very area, it will be considered as export. So there will be no tax impact on fish which is harvested within the exclusive economic zone. So it targets it incentivizes one of the coastal economies, or all our coastal economies, wherein fishing is one of the backbone of survival. Is fishing is not only done over there, but it's also forms a part of the entire economy over there. So this is something through which the coastal sector is sought to be incentivized, and impetus given to the coastal sector. 134, clause 134, as I had mentioned at the beginning, getting or transferring goods from one warehouse to another requires permission of the proper officer, which can lead to administrative bottlenecks. That is sought to be done away with. So if an owner of a warehouse goods wants to transfer it from one warehouse to another warehouse, it can be done without any prior permission. Then, as I had mentioned at the beginning, so tariff rates in the first schedule. So the customs tariff structure is sought to be simplified. Uh, and in terms of the second, third, and fourth schedule of the finance bill, this has been done. So new tariff lines will be created to implement these changes. The idea is that we have less of exemptions, and wherever the exemptions are there, the standard rate and the exemptions are there at the same go. For e-commerce sectors, which will also benefit MSMEs and artisans, one aspect which one has to evaluate is the removal of value cap for courier export. So the 10 lakh cap, which is there on commercial exports through courier cap, is no longer going to be there from 1st of April 2026. So therefore, this will greatly benefit the MSME sector, the artisans and e-commerce exporters through more global access. Similarly, for courier shipments which are returned, it can be directly sent back rather than being destroyed or rather than being auctioned out. This is again something. So these are aspects of ease of doing business. Yes, and now customs tariff changes. So a lot of aspects. So the budget has focused on a lot of aspects, on a lot of sectors to be given impetus. So we are looking at energy sector as one of those sectors which has been traditionally for the last course of few years for us to be energy compliant economy. Impetus has been given. So now exemptions have also been given for manufacturers of lithium-ion cells battery for energy storage systems. Similarly, on specified electronic parts used for manufacture of microwave ovens, there has been an exemption provided. Honorable Finance Minister had started the budget by saying that we are going to give impetus to critical minerals, and 4 states have been identified as the mineral belts zone for critical minerals. So on capital goods used for mining and processing those minerals, there has been BCD exemption. Similarly, for aviation and defense, parts for aircraft manufacturer and raw materials for aircraft has also been exempted. Healthcare, 17 new drugs find a mention in the duty exempt list. For MSME industry specifically, import duty on umbrellas is being raised. On duty, all personal goods, the tariff has been reduced from 20 to 10%. And similarly for leather, extension of duty-free imports of inputs to shoe uppers. So this is also going to greatly benefit the footwear sector, the textile sector, and a lot of our sectors which are heavily dependent on these sort of aspects. Lastly, excise. As we all have been aware, NCCD is something which is leviable on tobacco. The rate has been increased from 25 to 60%. And in fact, the valuation under GST has also changed from 1st of February 2026. So all in all, the costs of cigarette, chewing tobacco, and other tobacco-related products are going to be more costlier from 2026, from 1/5/2026. So these are broadly the indirect tax changes. Mostly the changes have been at the customs angle and in context of our trade relations currently. So yeah, that is it from the indirect tax side.
Yeah, thank you very much for your detailed presentation, Mr. Roy. We have two questions. One is, can we issue commercial credit note excluding GST instead of tax credit note post supply?
Yes, so the commercial credit note, as we understand, is the financial credit note. So that process has not been done away with. You can very well issue the financial credit note. But given that now the law is worded in a manner, there was always a dispute earlier as to whether it will be a commercial credit note or a GST credit note. So commercial credit note is still advisable. It can be issued, but probably we should, given that the law now requires you a GST credit note to be issued, wherever possible, we should go for issuance of GST credit note, but commercial credit note can also be continued to be issued.
The same question again is with the post supply discount.
So this is with respect to post-supply discount only.
Okay. So we have this question only. I request to audience, if you have any other queries, please post your query in Q&A box. We are waiting for 2-3 minutes for your queries. Otherwise, we are wrap up the session for today. As assuming that we don't have any other question for today, so thank you very much, Mr. Roy, for giving the detailed presentation. We have one question in chat box. Some restrictions in granting provisional refund of 90%. Kindly guide what that.
So there is no restriction in granting provisional refund of 90%. So what will happen is when you file a refund application under RFD 01A, there will be a basic scrutiny, and assuming everything is in order, 90% refund will be granted. Earlier, this aspect or this benefit was not available for an inverted duty structure scenario. But now in Finance Bill 2026, this benefit is being extended to inverted duty structure scenario as well. So on the 90% aspect, there will be a basic check, and if it's found in order, 90% refund will be granted on a provisional basis. Then it will go into a detailed scrutiny, and eventually, if it is found that 100% refund is to be granted, balance 10% will be released. And if it is found that 90% was not to be granted because there were some other restrictions, or not restrictions, rather all the conditions were not complied with, or there was not an inverted duty scenario situation, then that 95% will be clawed back. But there is no initial restriction on giving the 90% refund, provisional refund.
Thank you, sir. Thank you, all participants, for joining us today and for making this session interactive with your asking your questions through to our speakers. Thank you to all our speaker for sharing their detailed insight and help our members to decoding the budget for their business point of view. And our next session will be on labor law code on 13th of February. So I would like to invite all the participants, those are interested to heard about this. We will be there on 13th. So enroll for that also. And yes, we are uploading this video on our website. We will share the link of the recording session with you through our thanks mail post webinar, and also the both the PPT of the speaker as well, so that you can directly reach out to them. So if you have any query related to direct tax or indirect tax or any consulting support you would like to see, you can directly reach out to them. Thank you very much.
Thank you. Thank
So
you.